What's really behind China's sudden directive for its EV giants like BYD and Geely to scrap plans for expansion in Europe? Could this bold move be part of a larger strategy? One that could disrupt Europe's EV market and redefine global auto alliances? Let's unpack the reasons driving this game-changing decision. China's electric vehicle industry has been making impressive strides, with companies like BYD, Geely, and SAIC leading the charge into European markets. But in a surprising shift, the Chinese government has directed its automakers to pull back on any major investment in European countries that support new tariffs on Chinese EVs. So, what exactly is at stake and what could have led to such a bold decision? This announcement came shortly after the European Union imposed steep tariffs on imported Chinese EVs, up to a staggering 45.3%. These tariffs were not just arbitrary, they came on the heels of a lengthy investigation into whether Chinese EVs were unfairly priced due to government subsidies. Essentially, Europe claimed that the Chinese manufacturers received government support, allowing them to sell at lower prices and undercut European brands. Now, with these high tariffs, Chinese EVs in Europe would lose a huge portion of their price advantage, making it significantly harder for them to compete. For automakers like BYD, which have been rapidly gaining traction in Europe, this was a massive blow. Why would they invest in new factories and retail outlets if their ability to make profit from selling EVs in Europe was suddenly under threat? The Chinese government's response was swift and direct, advising companies to pause investments in countries that voted in favor of these tariffs. Interestingly, while this was not an outright mandatory order, it was more of a strong recommendation. And when the government in China makes a suggestion, let's just say, companies tend to take it very seriously. The tariff decision also laid bare a rift within the EU itself. In the vote that determined these tariffs, 10 EU countries, including France, Poland, and Italy, supported the measure. However, 5 countries, with Germany as the notable example, opposed it, and 12 countries opted to abstain. This fragmented response within Europe adds yet another layer of complexity to the situation, and China seems to be using this division to its advantage. The government's directive encouraged EV manufacturers to focus on countries that oppose the tariffs, like Germany, or those that abstained from voting. Take BYD for instance, which has already been looking at Hungary, a country that voted against the tariffs, as a potential base for its European headquarters, and in Spain, which abstained from the vote. There was recently a $1 billion investment from a Chinese company to build machinery for hydrogen production. This selective approach allows China to maintain a strategic foothold in Europe while avoiding investments in countries that supported the tariffs. Now, here's the interesting part. Could this selective investment strategy end up dividing Europe even further? It definitely puts pressure on EU countries that supported the tariffs, especially those that were hoping for Chinese investments to boost their local economies and create jobs. This move by China isn't just about protecting its EV market, it's also about gaining leverage in its ongoing negotiations with Europe. By pausing or canceling plans for EV manufacturing plants in certain countries, China sends a very clear message. Yes, the European market is valuable, but it's not irreplaceable. Beijing seems to be making it known that if Europe wants to make the most of Chinese investments, it may need to reconsider its approach to these tariffs. And why wouldn't they? After all, Chinese EV manufacturers rank among the largest in the world, and their presence in Europe brings with it economic benefits that many European countries, especially those facing slower economic growth, could greatly benefit from. But then, here's the big question. Will Europe reconsider? That's something we don't have a clear answer to just yet. Europe definitely wants to protect its own domestic EV industry, but at the same time, some of its economies are showing signs of slowdown. Foreign investment in EV infrastructure and manufacturing could provide the boost they are looking for. For Chinese EV companies, Europe isn't just another market, it's a significant one. In fact, In 2023 alone, Europe accounted for more than 40% of China's total EV exports, making it a critical destination. But why does this matter? Unlike the US and Canada, where the steep 100% tariff blocked Chinese EVs, Europe has been a key market for China's EV exports, helping them manage overcapacity back home. But now, with new European tariffs threatening access to this vital market, China faces serious financial stakes. To China, keeping a foothold in Europe isn't just about sales, it's crucial for balancing production and supporting its booming EV industry. That's why negotiating a solution has become a top priority. During a meeting on October 10th, Chinese automakers received specific instructions not to approach European governments independently, but to instead coordinate their actions as a united front. By doing so, Chinese companies can negotiate more effectively and prevent Europe from trying to exploit divisions between competing brands. This collective approach marks a shift from earlier strategies, where companies like SAIC and Geely had independently explored opportunities in Europe, sometimes even in countries with conflicting interests. This directive from China doesn't mean it's stepping away from European investments altogether. Instead, it marks a clear shift in strategy. Chinese automakers are being encouraged to concentrate their efforts in politically favorable countries, places that either opposed the tariffs like Hungary or chose not to take a side, such as Spain. Take Hungary, for example. It's already emerging as a strategic manufacturing hub for Chinese companies, with BYD setting up a base there. In fact, BYD is even rumored to be considering relocating its European headquarters from the Netherlands to Hungary, drawn by not only lower costs, but also Hungary's favorable political stance toward China. This approach allows China to maintain its presence in Europe, but in a way that aligns with both its economic goals and diplomatic interests, showing that it's playing a calculated game in this high-stakes market. So, what does the future hold for both China and Europe? This situation is a clear example of how economic strategy and geopolitical maneuvers are deeply interconnected, especially in industries as globally relevant as electric vehicles. Will Europe stand firm in its tariffs, or will it reconsider in the face of potential lost investment? In the end, China's directive for its EV giants to hold back on major investments in Europe isn't just about tariffs or economic strategy. It's a calculated move in an intricate global chess game where each side is trying to protect its interests while also asserting dominance. Europe wants to shield its automotive industry from what it sees as unfair competition, while China is determined to carve out its place as a leader in the global EV market. The real question is, who will blink first? With both sides holding significant advantages and playing high-stakes strategies, it's clear that the future of the EV market is standing at a critical tipping point. The outcome of this standoff could very well shape the automotive industry for years to come. Who do you think holds the upper hand in this showdown, China or Europe? And what do you think will be the outcome of this economic clash? Let us know in the comments. If this standoff has piqued your interest, make sure to like and subscribe for more insights on the EV market and global trade dynamics.